Hi, this is Joe Elsasser, President and Founder of Covisum and also a practicing financial advisor, and welcome to another FinPlan Friday. Today we're going to talk about some of the changes that could happen as a result of the Biden tax plan. Now, of course, these are proposed changes, and in reality, there's a huge political process, a lot of negotiation that will have to happen in order for any of these to actually take effect. But these specifically are 4 changes that we'll address today that we'll want to be paying attention to because they would have a really significant impact on how to build efficient retirement income plans. Now, the first change is a change in taxation for current employees that goes to pay for Social Security. Now, currently, you pay taxes on up to about $140,000, and this is FICA taxes, where you pay 6.2% as an employee, and the employer pays an additional 6.2%, for a total of 12.4% that goes into the Social Security system. Now, the proposal is that that structure continue, but then also be reinstated for people who earn over $400,000 a year, in effect creating a donut hole. So we would have the current taxation structure where you're taxed on up to about the first $140,000, which is indexed each year for inflation. But then for high wage earners, they would begin again paying their 6.2, and for self-employed people, both halves, for a total of 12.4% on income over $400,000. So that would be a pretty significant change for high wage earners. Now, a second potential change under the Biden tax plan is a change in capital gains, and that's specifically a change in the step up in basis. Now, right now, if let's say that I bought a stock today, and in 20 years, let's say that stock triples in value. So I have this low basis and this high current value as of my death. At the point of my death, under current law, I would get a step up in basis, or rather my heirs would get a step up in basis. So if they sold that stock on the day after I died, they would pay only the difference between the date of death value and the day they sold it. So they would pay very little capital gains tax. Now, the idea of eliminating the step up in basis could be one of 2 things. Thing one, I suppose, would be carryover basis. That's the possibility that they would retain my original purchase price as their new basis. They wouldn't be taxed until they actually sold the asset, but they wouldn't get that step up in basis that would allow them to sell the asset with very low taxation. So that's one possibility. The other possibility is an immediate taxation of the difference between my basis and the value as of the date of death. Now, both of these situations would create real planning imperatives. Rather than holding assets with the expectation of an eventual step up in basis, we might be more tempted to make sure that the portfolio is aligned all the way throughout retirement, as opposed to, kind of having to play this balancing game between it's a pretty good asset, but we've got a big tax liability built up, and that's often the case right now. Now, the third major change is a change in the estate tax exemption, and this has bounced all over the place through the years. When I first got into the industry in 2000, it was $1 million. And it's bounced all over the place. It's currently $11.7 million that you can have in your estate before you face any estate taxation. The Biden plan proposes to bring that number back down to $3.5 million. Now, that would bring a lot more people back into the fold for estate taxation, and what it would do is create a whole lot of different planning opportunities. Gifting earlier on in a retirement period. It might create situations where life insurance becomes valuable again as an estate planning tool, where for mass affluent and lower affluent people, it's certainly less valuable than it was 20 years ago. So there are a variety of opportunities, planning opportunities, that would arise from that estate planning change from the estate tax exemption. And the fourth is an increase in top tax rates. Now, right now, the proposal is only to increase the top tax rate from a current 37% under the Tax Cuts and Jobs Act back up to 39.6%. And that was the pre-Tax Cut and Jobs Act level. Right now, that's the only change. At the same time as these issues are negotiated through Congress, you can imagine that there will be a variety of pressures on both sides to say maybe we should bring down some of the other tax brackets, maybe we should adjust the thresholds. So needless to say, I don't think there is anyone out there suggesting that under this new administration that taxes are likely to go lower for lower affluent or affluent taxpayers. If anything, it is potential for higher taxes, whether it's capital gains taxes, estate taxes, or income taxes. So the next few years before these tax changes have a chance to take hold is really a great opportunity to take advantage of some of the most historically low tax rates. Some of the things that we're doing, and we're seeing other top advisors around the country doing right now, are really looking hard at Roth conversions. Roth conversions can be a fantastic tool, particularly when someone is in a particularly low tax bracket right now. A second thing that we're seeing quite a bit of is harvesting of capital gains, not just capital losses, but capital gains. Sometimes it makes sense, particularly for someone who might be in a 0% capital gains bracket or has some room between the point where their Social Security is fully taxable and then they're waiting to be kicked into a higher tax bracket, to actually harvest some capital gains and either take advantage of a 0 or a 15% tax bracket if it's unlikely that those brackets will be available later on in retirement. Two fantastic techniques to begin thinking about at minimum, and for some clients, definitely implementing now in this era of historically low tax rates. Thanks so much for joining us today. We look forward to seeing you next month for another FinPlan Friday.